If you're a real estate investor, you're not utilizing cost segregations, leaving a lot of money on the table. Whether you're buying residential or commercial properties, these can be applied to both of those and basically keep tens and thousands of dollars more in your pocket. And for the larger ones, much more savings annually once tax season rolls around, keeping money in the bank and opportunity to either grow, scale, or invest other places. I'm Brandon and I am a real estate agent and real estate investor here in Columbus, Ohio, and wanted to break down on what it looks like to utilize a tax strategy that I have done multiple times before. It's called a cost segregation study. So what is a cost segregation study? A cost segregation study is basically the rate of depreciation on a property. So the US tax code states a residential property can be depreciated at 27.5 years, and for commercial, it's gonna be 39 years. The entire building is depreciated at 27.5 years, longer of a time period, versus if you utilize a cost segregation study, then you basically break down different components of the property because not everything or material in the property is the same lifespan. Certain items could be depreciated at a 5, 7, and 15-year depreciation rate, basically forcing depreciation to speed up a lot quicker, saving massive amount of money depending on the property size. So why do investors pay attention to this strategy? It's because essentially keeping more money in your pocket at the end of the day. You're speeding up the depreciation, and this is basically more deductions over earlier years of owning the property. Residential, it's 27.5 years for the entire building, and for commercial, it's going to be 39. But when you have more money in your pocket, this basically means you have less money in the deal, which increases cash flow after tax savings, and your return on investment, or ROI, is ultimately better by doing this. So let me give you an example, a property that I recently did a cost segregation study on and what the numbers and breakdown look like of it. So this is a fully renovated duplex that I just refinanced at about $350,000 value, but we're actually all in $290,000. So about 60 grand equity was created in that, but we're gonna be starting with our basis of $290,000. Off the rip, we have to subtract about 15% of this value for land, because land is not included in this cost seg studies. That brings us down about $40,000, and our depreciation basis now we're starting with is gonna be $250,000. So from there, we're gonna go ahead and break down the different levels and components of the material and what can be accelerated in different years. So if you take 250,000 divided by 27.5, that's gonna be about 9,100. So that's gonna be your depreciation and savings versus putting about $45,000 in that bucket of a 5-year depreciation, about $20,000 in that 15-year, and then the rest remaining of the building is gonna be about $6,700 in savings, making this overall savings and depreciation rate of about $55,000 to $70,000, which is a much bigger difference in that depreciation. So how do you actually save money on taxes using this example? Let's talk about the same property and say it brings in about $25,000 a year in rental income. So using the $9,100 on our property without the cost seg study brings us to a taxable income of $16,000. But when you do it with the cost seg study, you're gonna have the same rental income of $25,000, and now we have a range of $55,000 to $70,000. We're gonna call it $60,000 for this example, and $25,000 minus $60,000 is going to be a paper loss of $35,000. So instead of getting taxed on that rental income, you are now creating a paper loss for yourself, and that is the main benefit of how this actually works. So the misconception on a cost segregation study is going to be that it's only for larger deals and large buildings in general. This is not true. It can be done on single family, small multifamily, short-term rentals, and then of course is a bigger savings when it comes to larger buildings like retail centers, hotels, warehouses. At any point in time on this cost seg study, it can be done on large to small properties. You can also go to certain websites and do the cost segregation yourself, things like DIY or do-it-yourself costsegregation.com, as opposed to paying a lot more money for a study done by a third-party vendor. So I do it myself. I basically see if my property qualifies, what the losses look like, check all my work using a CPA. That's a disclaimer there. Always consult your CPA and make sure you're getting tax advice from the professionals. I've done a cost segregation study on my properties over 5 times now, and I've done it myself and basically get references and should get it checked by my CPA to make sure everything's correct. I'm not a CPA, so make sure you, at the end of the day, you are consulting with your tax professionals on this. But if you need help or have interest in investing in real estate, feel free to reach out to me. And of course, if you found this video useful or found any help out of it, feel free to like and subscribe. Thanks, guys.